My name is Deepesh Patel, editor at Trade Finance Global. There's never been a more important time to discuss risk when it comes to trade finance. Today, we're talking about the developments in the trade credit insurance space. Corporates will often purchase trade credit policies to either transfer risk or for financing, and banks might utilize policies for capital relief. But do traditional TCI policies accommodate both banks and corporates? And are there any new advances or innovations in the market? Today, I'm joined by Meera Saunders, trade finance underwriter at AIG and one of our 2021 inspirational women in trade. Meera, hello and welcome to Trade Finance Talks TV.
Thank you so much for having me, Deepesh.
Thank you. So elevator pitch in no more than 30 seconds or so. Who are you? Where are you from? And what do you do?
Thank you. I'm Meera Saunders. I'm an underwriter within the trade finance team at AIG, and I'm also responsible for operations and strategy. I've been at AIG for 10 years now, based in London, and I've had a variety of different roles.
Extremely experienced. So can you paint a current picture on the trade credit insurance sector? How do corporates and banks currently go about obtaining credit insurance policies, and what are the challenges?
Sure. A corporate often purchases trade credit insurance for risk transfer purposes, but they also often use these policies for financing. Traditionally, they would do that by adding a bank on as a loss payee onto their policy. But we found that that might not be optimal for a bank. Trade credit insurance policies are quite conditional in their nature, as the expectation is a corporate would be managing their own risks in a prudent manner. And they also want to retain some control over their own, policy terms and conditions and buyer limits. Whereas a bank, in order to obtain capital relief, may need a more limited conditionality policy. And therefore, we often find that the needs of a corporate and a bank are slightly different.
Yeah, absolutely. So can banks using trade credit insurance get capital relief under the current Basel regulation using their current policies?
In our experience, banks are often able to use our trade finance policies to obtain capital relief. Our team specifically work on policies where the insured is a financier, so we really understand what the banks need. And therefore, when we're writing our trade finance insurance policies, it is with the bank in mind rather than traditional trade credit policies, which has a corporate insured.
Thanks, Meera. So I know when we last spoke, you talked about AIG creating the Trade Credit Bridge, or TCB. Can you tell me what this is and how it actually helps with respect to, say, capital relief?
Yes, absolutely. So a trade credit bridge allows a corporate to maintain their own trade credit policy and a bank to have their own trade finance policy. And an endorsement bridges the two of those policies together with a shared limit. So the corporate is retaining control of their own policy and buyer limits. The bank has its own trade finance policy, which might be a lot less conditional. So traditional policy conditions that might apply to the corporate's policy, for example, deductibles and compliance with credit and collections procedures, wouldn't apply to the bank's policy. So the bank has its limited conditionality and it should allow it to achieve capital relief.
So are the limits shared, and do banks have more control with respect to their obligors?
The corporate can choose which of its buyers it wants to assign for financing. So the receivables owed by which buyer would be sold to the bank. And then it just depends on whether that receivable was sold. If it was sold, then it would attach to the bank's trade finance policy. And in that situation, if there was a loss, the bank's policy would respond. But if the corporate chose not to sell that receivable, then it would attach to their own trade credit policy.
Got it. So does that mean that the cost of the premiums is shared? And if that is the case, what's the benefit for AIG?
There can be synergies between a bank achieving capital relief and the impact on the all-in cost for a corporate's cost of financing. From an AIG perspective, we're sharing capacity, which means we're not having to deploy this capacity twice. That could lead to us being able to perhaps offer larger limits or even just further opportunities to deploy this capacity. Additionally, sometimes we get names that are in quite high demand and there may be limited capacity out there in the market. So again, this shared limit option is a great solution to that. From a premium perspective, there can be benefits depending on how the deal is structured and the needs of both the corporate and the bank.
Got it. So let's take a step back, and I'll put this diagram on the screen. Can you talk us through the process of a trade credit bridge versus the current way banks and corporates obtain policies?
Absolutely. So to give you a bit of a background, the way this solution came about was a bank approached us looking for a policy, and they produced this corporate trade credit policy that they tried to heavily edit to, fulfill their needs. And so we came up with a solution that said, rather than you going through this whole rigmarole of trying to make a corporate policy work for you, why don't we use your trade finance policy, allow the corporate to keep theirs? And we created this bridge solution that combine the two together, although there still remain separate policies. So the way that this works is a corporate can choose which of its buyers it wants to utilize for financing. It could be one, it could choose all of them. That's entirely up to the corporate. They would then still retain control over their trade credit policy, including any buyers that they haven't included in the financing. The bank would then get its own policy, which is usually on their approved wordings. Banks often have to go through lots of approvals, so this is also a great solution for them. And an endorsement attaches to the corporate's policy, and the corporate signs this. That bridges the two limits together, so they end up with this shared limit.
So it would appear that there is a bit of a win-win for both banks and corporates. Can you just run through some of those advantages of using a TCB from both sides? And does AIG's TCB reduce cost?
It can be a cost-effective solution, depending on the needs of the parties. We have absolutely seen it reduce costs, but it very much depends on the structure being presented. The main advantages are that both parties, the corporate and the bank, are getting what they need from their various different policies. They're not trying to combine the two policies together. Corporate has its own trade credit policy that it retains control over, and the bank has its own policy as well, with limited conditionality that should allow it to get its capital relief. Another main advantage is the flexibility in the limits. So the shared limit option means that a receivable owned by the corporate could be sold to the bank, in which case the bank's trade finance policy would respond. But if it doesn't, then it just stays with the trade credit policy. And another point to mention is that the bank can use its own approved wordings. Banks often have to go through such long approvals procedures, so any even changes in their policy wording or new wordings can take such a long time to get through. And so this kind of addresses that by saying, well, you've already got your approved wordings, we can use that.
And does that mean that AIG sits as the underwriter for both parties?
Yes, so the AIG would be the underwriter for both the trade credit policy, which is the corporate insured, and the trade finance policy, which is the bank insured. If we didn't hold the trade credit policy, then this would just be a straightforward trade finance policy with no bridge.
Got it. And do any other underwriters in the market provide a trade credit bridge or equivalent instrument?
We have trade credit bridge policies that are syndicated. So we have brought other insurers involved in the trade credit and trade finance policies, and therefore the bridge solution. However, I believe that AIG are leading the execution of this style of product.
Got it. Okay. So, let's go into a bit more detail. Do you have any kind of case studies or examples that you could provide our viewers?
Absolutely. So we've had a long-standing trade credit client. They're a large mining company, and they came to us because they were hoping to add on their bank as a loss payee on their policy, thinking that that would allow them to use it for financing. They were surprised to learn that the bank required a CRR compliant policy in order to achieve their capital relief, and so they weren't able to be added on as a loss payee. Whereas the corporate still wanted to use that to have their own policy to maintain control of their buyer limits. Additionally, a lot of the buyer names under their policy were in high demand in the market, so it was very difficult for them to get additional capacity in order to service the bank policy. So we provided our TC Bridge solution that allowed them to share the limits, so the capacity issue didn't become a problem. And it also allowed them to keep their trade credit policy and maintain control of their buyer limits. And their bank had their own CRR compliant policy and were able to achieve their capital relief. So it was absolutely an ideal solution for all.
Very interesting and definitely a win-win there. So I guess moving forwards, what's next for the trade credit bridge policy at AIG?
We believe that the trade credit bridge solution is an innovative solution for a problem that we're seeing more and more. Corporates are increasingly looking to leverage their policies for financing, and banks are under such heavy regulation, particularly with capital requirements, that we feel that this is a solution that, this is a solution for all parties involved. And what we really want to ensure is that the corporates and the banks are aware of this solution that AIG can offer.
Yeah, I think it's really, really interesting, and probably not many people have heard about this relatively new product, and definitely worth exploring, especially given the different objectives from a corporate and bank perspective and how they can be aligned with some form of bridge policy. So Meera, it's been an absolute pleasure, as always, having you on Trade Finance Talks. Thank you very much for joining us, and hopefully we'll see each other in person sometime soon.
Thanks very much, Deepesh. It's been a pleasure.